4 years, and this is our 180th webinar. More than 125,000 participants registered, and more than 250 panelists have joined our program, and they gave answer and their wisdom to all the participants. Now, our main focus when we are organizing program, we are just focusing on these concept paper which are coming out from any regulator connected to the corporate law, whether it's SEBI, MCA, RBI, IBC, CCI, or others. So the purpose is that always in India, we are reactive. When some law is coming, we are silent. When the law is finalized, then we are active. So what is happening when the law is passed by the parliament, passed by the regulatory process, then if we are criticizing or suggesting, it has no meaning. It is good that SEBI is coming out always, that whenever they are making any law, they are asking public comments. And the program's importance is not after the implementation. The program's role important is when we are reacting on the suggestions, and accordingly, the government is modifying. So we are focusing always on these types of program. So today's program is also in the same line. The SEBI has come out with concept paper of various changes in ICDR and LODR. And when I was reading this, there are 51 suggestions they have come out. And some of the suggestions are really very nice, very good, and in the right direction of ease of doing business. Now, this consultative paper is recommendation of expert committee for facilitating the case of ease of doing business and harmonization of various provision of ICDR and LODR. Now, this expert committee has recommended changes in LODR regulation to enable a single filing system through API regulation to enable API integration between stock exchanges, integrating periodical filings, system-driven disclosure of certain filings, streamlining promoters' reclassification process, exemption for certain RPT, additional time for disclosing board meetings outcome and litigation, permanent allowance of permanent permission to the virtual shareholders meeting, and introducing provision relating to appointment, reappointment, removal of disqualification for Secretarial Auditor, changes in ICDR regulation, that is a second part, which is talking about including combining pre-issue and price band advertisement, allowing QR code links to additional information and voluntary disclosure of proforma financial and public issue, right issue, and the QIP, and removal of employee reservation and right issue. Now, and then they have given the ICDR and LODR where the harmonization is required, because when you are changing one part, other part is impacting. So they are asking comments on that also. And in the process, we can give comments on this also, that anything is missing out, we can suggest them. So the objective of this webinar is to discuss the recommendation of expert committee and gain insight into the potential implication and what proposed changes they are suggesting, and the various prospective and suggestion of the participants coming out in the webinar will be collated and sent to SEBI for their consideration. So this is the object of the webinar, that we will collect all the suggestions, and during the discussion, when one speaker is speaking, another person is suggesting, that is also one part. So today's webinar, we have a very learned speaker. I will start with Lokesh Bhandari. He is a Associate Vice President, Listing Approval of NSE. He has worked experience in NSE around 1 decade, where he has been part of the entire listing documents, listing departments and its documents, both listing approval, listing compliance, Further, he's also very closely working with various SEBI team and actively discussing on various regulatory framework. And he's the one of the right person who is involved in this and who is will give you the insight. Then we have a Geetika Anand. She is Company Secretary and Compliance Officer of Hindalco Industry. She joined Aditya Birla Group in 2006 and continued to be associated with Group with the diversified experience in corporate secretarial compliance, corporate restructure, and M&A. And Geetika was a member of this expert committee, and she has actively participated in this suggestions which we are discussing today. So we will definitely get insight from her about the changes and what are the reason and how it has come out. Then we have Ankit Singhi, Head Corporate Affairs, Compliances, Corporate Professional. Then we have Ms. Anjali Agrawal, Partner Head, Capital Market Service, Corporate Professional, and Manoj Kumar, Partner Head, M&A and Transaction, Corporate Professional. So all these three people, they are doing practice in this area, and every day they discuss with the client and identify their issues. And when I was talking to Ankit, he was very happy that SEBI has really done the ease of doing business if this implemented in full. So today we will discuss about the important recommendation related to LODR, ICDR, aiming to streamline the compliance and enhance corporate governance for listed company. Some because you understand this all these suggestions which SEBI is recommending in LODR, that is for enhancing of corporate governance. But under the process of corporate governance, sometimes what is happening, it has become cumbersome for the compliance officer in the company and the promoters and directors. So they have planned that how to make it effective, like take example of filing information, filing various forms, filing various things. So if you go to the stock exchange portal, you will find the bombardment of information. So now they have categorized and they have identified which information is not relevant, should not be given. Because sometimes if you don't want to give any information to anybody, the best way is give more than what required. So it will lost its relevance and people will not get. So it is better. The stock exchange system should be like this. And when you are filing, just like we are seeing on various airports, that there is a collection of waste. So they have segregated to 3 parts, 4 parts, some there 5 parts also. So here also the stock exchange system should be there. This is important, this is not important, this is only for compliance, should be there. So today the entire discussion will be divided into filing and disclosure in LODR, board and directors committee, promoters and controlling shareholders, and including reclassification, that is a very painful process. Then related party transaction, disclosure of material event, other compliance requirement, strengthening corporate governance, that is in LODR. In ICDR, combined advertisement issue, public announcement timing, loan utilization certificate, IPO eligibility, and standalone financial information of working capital. Simultaneously, I was just reading that they have allowed the reduction of capital if there is a loss in the company, and for that you don't require capital stock exchange approval, just you have to give information. Manoj will discuss about this, how will beneficial this particular thing and how important it is. So friend, we will discuss all these things. I will tell you the program structure is, first Ankit is giving the recommendation on LODR, then Anjali will give recommendation on the ICDR, and then Lokesh will tell us the stock exchange type point issues and various other aspects relating to this, that what company should do and what are the issues he feels that public should realize and suggest them so SEBI can modify it. And then Geetika will join and she will give the overview that what is the logic of all these changes. And then we will have question answer session where Manoj will also join and he will discuss about the implication on certain specific aspects of M&A transaction and various other things related to ICDR, which is useful, and conversion on loan and other things will be there. So friends, this is the structure which we will follow. We will have a 30 minutes question answer. So anybody has any question, you can write during the program. We will do poll also to get the feedback from the all participants, and we will move on. Before starting the program, I'll just announce our next webinar is 181 webinar on unfolding ESOP valuation and taxation aspects. We'll do on 19th July at 4 p.m. on Friday. So I'll join everybody. This is a very interesting topic on ESOP, but this time we are doing on the valuation and the tax aspects. So everywhere, everybody who has issued company side ESOP, so what is the tax issues, what are the other issues you can discuss, and valuation aspects. And secondly, those who have received ESOP, that is also beneficially for them. So now I will start with this, and at last I will do the question answer. So please write down your questions on the mailbox and we will read it. So Ankit, over to you on LODR, please.
Thank you, sir. Good evening to everybody. And as you mentioned, my name, these are actually wonderful suggestions, and it could actually turn the LODR regulation upside down because there are so many changes. I start reading the changes and it was not going to end, and they were just very good, very, very detailed. And I think what was kept in mind is in terms of the practicability of the compliance and the objectivity also behind it. So I'll try to rush everybody through with the proposed changes, and then we can also take some questions if there is any. Okay, just give me a sec. So I hope the presentation is visible.
Yes. Yes, okay.
So we have divided our presentation in 3 parts as divided in the report of the expert committee. And since there are proposals with respect to amendments in LODR regulations, then there are proposals with respect to amendments in LODR regulations, ICDR regulations, and then there are some amendments which try to sync certain provisions under both LODR and ICDR regulations. I will take you through the provisions related to LODR regulations, and then Ms. Anjali will discuss the provisions related to ICDR and the syncing provisions related to ICDR and LODR. So I think we'll start with the filing and disclosures. One of the main challenges that I think, and it was a long pending demand, that if I'm listed at 2 exchanges primarily, that is NSE and BSE, I have to file anything. I have to go and use the filing modules of both the exchanges and then upload something. And if at any point of time there is any minute or something, there is a delay in filing any disclosure on any one portal, you receive a email citing that some penalty has been levied in accordance with the SOP issued by SEBI. So one fundamental proposal that this report makes is coming up with a common platform where I think exchanges have represented to the committee that they are working on a common platform where if you file one document at one exchanges, the other exchange will automatically fetch it through some interlinked API. So therefore, you will not require to file some announcements on, all the announcements on both of them. You have to file it only one of them. This is the final approved proposal as to where you have to file. Either it will be either side that you file in either of them, and then the other one will fetch the required disclosure. So that will save a lot of time, and you only have to file the all the disclosures like CJE, corporate governance, investor grievance, disclosure under Regulation 30. All these will be only filed at one exchange, and then the other exchange will simultaneously pick the same. So that would be a huge leap, and it will definitely save a lot of time in uploading and preparing XMLs and uploading at both the exchanges. So this is a very welcome change, and considering the technological advancement and all these things, I think it's a need of the hour that we should have one uniform set of filings. And if there are additional exchanges in future, then they can also tap with others through this API integration. Another is that the committee also evaluated on various types of quarterly filings that are there, and they deliberated on how they can reduce the numbers of filing or try to bring about some kind of ease in undertaking those filings. So if I consider two filings, filings in two sense, that one filing is with respect to like corporate governance report, investor grievance report, shareholding pattern, then there are financial results, deviation related intimation, and related party transaction disclosure. So what the proposal is made in the expert committee report, that they have come out with two integrated filings. One is with respect to governance related filing, and other is with respect to the financial filing. So with respect to governance, they have combined the corporate governance report and statement on redressal of investor grievances as one integrated filing, and then financial statement, statement of deviation, and RPT, they have combined as one set of filings. So when you will be undertaking that filing in a single filing, you can file both the things as with respect to governance, and in case it is an integrated filing with respect to financials, you can file three different disclosures that you are required to file through three different separate filings through a one single filing. And they've also put out the format of the filing as part of the report. So timings will remain same as it is there, but corporate governance report, investor grievance report, I think it is 21 days. This is will be 30 days from the end of the quarter. Another is that they have done away with some filings. Like there are some filings with respect to RTA, that company has appointed an RTA. Then even with disclosure with respect to loss of physical certificates, and then there is a regulation 40 disclosure with respect to processing of physical shares and share certificates, duplicate certificates, transfer, transmission. So since the committee suggested that RTA can be shifted to the corporate governance report, or it is also already captured as part of the quarterly share capital cancellation report, but it can also be captured in some other report. So therefore, there should not be any need for filing this submission. Physical certificates and on the annual certificate, since now physical certificates have not been in use, letter of entitlement is issued in all these cases. So therefore, there was also no need of filing these disclosures as part of the disclosure regime. So all these three disclosures have been suggested to be removed from the requirement from the LODR regulations, and no more filings will be required as and when the amendments are made and notified. As I mentioned about three filings under corporate governance, investor grievance, and shareholding pattern. So shareholding pattern, they have not tried to combine with corporate governance and the investor grievance filing. In terms of shareholding pattern, similar to other SGD filings under PIT regulations and takeover regulations, what they propose that similar filings can also be automated from the exchanges of depositories, because ultimately RTAs and everything, the data that is downloaded from the end of the depositories is actually then converted into those XBRL filings and uploaded on the exchanges. So the committee looked into this fact and recommended that similar to other SGD driven filings, shareholding pattern is also something, because it is totally data driven and data which is also sourced from a third party, that is in depositories, it can also be automated. Similarly, for credit ratings also, there is a recommendation that the credit rating agencies can have an integrated API with the exchanges, where as and when there is a disclosure with respect to new on revision in credit ratings, that can also be automated. So apart from automated disclosures on PIT and takeover, there will be two additional automated disclosures, one with respect to shareholding pattern and one with respect to the credit rating. Actual procedural formalities or manner of doing it will be notified as and when the amendments are made. Then with respect to website disclosures, one of the things that committee discussed, that there are a lot of duplication of things that are required to be posted on website that are already available on the exchanges by way of various filings. So there is a recommendation that for all the filings where something is already available on the website of the exchanges, the website of the company can give a reference to that link, that these kind of filings can be referred to the website of the exchanges, and one can visit that link and find those which has been uploaded there. Companies need not to do a simultaneous upload on their website, so that they can avoid duplication of posting of same data on two different websites. Another option is to do away with the publication of financial statements in the newspapers, and instead of that should be published boxed with a QR code and web link where financial results can be accessed by using the QR code. For the investors' convenience, I think for debentures they've already dispensed with the requirement of submitting the financial results. Similar requirement is now also proposed for the listed entities, but I also don't feel that this QR code will also make a lot of sense. It can be either sent through email or it can be sent through SMS. Now companies have access to all these details. Then it would be looking very weird on a website that you will have small boxes of different companies with the link of the QR code and the web link. Though as can be done as recommended by the committee, but I believe good companies will still continue to publish their financial results. But if they don't want to, they can use the option of publishing a QR code as and when this is introduced as part of the amendments to the regulations. But definitely something which is very welcome. Save a lot of cost because when companies publish results in newspapers, it entails the cost, which would be much lesser as in case of publishing a QR code or along with a web link. Then on board of directors, vacancy in the committee. So there is a concept that in case of board of directors, there is a timeline prescribed of 3 months for filling a vacancy. The committee deliberated that no such timeline has been provided in case of a committee, because it might be possible that due to that vacancy in the board of directors, that has resulted into a vacancy in the committee, and at times there are regulatory actions that are taken by exchanges on account of the composition of committees not in line with the requirement. So therefore, similar to the lines of filling a vacancy on the board of directors, there is also a recommendation that there also a provision can be or will be introduced where there will be a similar timeline of 3 months will be provided to the board for filling such vacancy in the committee members. If this, I believe this should be linked to the vacancy on the board, because if there is a vacancy on the board, but board has sufficient number of directors to appoint in the committee, I don't think then this period of 3 months should be available. Then with respect to timelines for approval, currently there is a requirement of taking approval in 3 months or the general meeting, whichever is earlier. The government has come up with a recommendation that in case there is any requirement of any obtaining an approval of regulatory, statutory or government approval, then the time taken for such approval has to be excluded, and only once the approval is received, then only the 3 months trigger should be there. Similarly, there was also a proposal which was considered by the committee with respect to nominee directors, that all kinds of nominee directors should be excluded with the requirement of taking the approval of shareholders. But they have not acceded to the request in entirety. They have created a provision. They have recommended a provision whereby a nominee director appointed by a financial sector regulator like RBI or by a court or tribunal can only be exempted from the requirement of seeking a shareholder's approval. All other kinds of nominee directors appointment will have to meet the requirement of seeking a shareholder's approval within a period of 3 months or the next general meeting, whichever is earlier. So this is important. I think similar amendments have already made in KMP with respect to excluding the timeline, but that timeline has only been extended to 6 months. Within 6 months, you have to obtain the approval of the regulator. Now, in case of directors, there is no limit on the timeline. The entire time that the company takes in getting the approval will be excluded from the requirement of the 3 months approval timeline. Promoter and controlling interest. So there is a provision under the LODR regulations which talks about reclassification of promoters from public vice versa. And there is a detailed procedure which is prescribed, and as per the timelines outlined in the expert committee report, it tends to take around 240 days to get a reclassification process completely executed. And the current process is that you have to file a request with the board. Board will contemplate on the request. Then it will go to the shareholders, obtain their approval, and then post obtaining the approval of the shareholders, that it will go to the exchanges. Some of the submissions that were made before the committee that exchanges brought this fact that at a lot of times when the approval application is filed after taking the shareholders approval, at times there were a lot of things which are which are not there. The application is deficient. As a result, at many occasions, company has to go back again to the board to take their approval again and to take the shareholders approval. So considering the same, the committee suggested a new manner of processing the request, and also um, recommended certain fresh timelines which will reduce the timelines from current period of 240 days to around 160 days. So say there will be a reduction of around 80 days from the current process. So current process will be, once the company receives a request, within 2 months it has to call a board meeting. The current requirement is of 3 months. Then as soon as they receive, the board considers the request. Within 5 days, it has to file an application with the exchanges. Exchanges have to consider the request within 30 days. And post the request is approved by these exchanges, within 30 days, the company will seek an approval of shareholders within 60 days. And once the shareholders approval is done, within 5 days, it has to notify that the reclassification process has been completed. And another important thing is, yes, this is, as I mentioned, 30 days notice period, 30 days NOC, listed entities to seek approval within 60 days, and within 5 days, you have to complete the notification process. Then you have to seek fresh approval in case there are changes in the facts and circumstances after receiving the NOC. So if you receive the NOC and there are certain changes in the facts and circumstances, then you have to reapply to the exchanges with respect to the approval. In case entities don't follow the process as prescribed, proposed in the regulation, there is also a penalty that have been provided, that exchanges will be entitled to impose a penalties in cases where the companies are not meeting the timelines outlined under the regulation. There is also one requirement that as part of the filings, when you receive a request, you have to inform the exchanges. When the board meeting considers the request, then there is a current requirement of filing a board minutes. So the requirement of board minutes have been is proposed to be done away with, and only the outcome will outline the broad views of the board on the reclassification request. So a lot of changes have been proposed to rationalize the timeline. I think the focus is on timelines. While considering the request, two important other recommendations were made, that which proposals were considered by the committee. Like is with respect to the untraceable promoters, there was a proposal that a process can also be outlined for reclassification of untraceable promoters, to which the committee didn't agree. It thought that it can be misused. Then there was also a proposal for further rationalization of provisions of shareholders holding a very minority stake in the company, for which the committee noted that there is already a provision under the reclassification regulations, where if you are holding, I think, 1% or less, then there is a different procedure that have been outlined. This procedure doesn't apply. So a lot of things were considered by the committee on these aspects. I believe Anjali can also throw down, because she does these applications on a very regular basis. If you have any point to add.
Thank you, Ankit. So all these provisions or all these proposed amendments are on the basis of the practical difficulties or practical cases that were being faced by the exchanges. So what is proposed, that too with regard to the shareholders, to the stock exchanges NOC, because many a times it was happening that the company was taking shareholders approval, company was undertaking every step, and then when it used to go to the exchange used to say that no, these persons are not reclassifiable. They either are the siblings or father son duo, so they cannot be reclassified. So accordingly, exchanges, I think this is a very good move, wherein at the initial stage itself, we'll take the exchange approval, exchanges in principle, and then only we'll proceed. The company will be proceeding with the whatever additional steps in terms of shareholders approval and making disclosures the company would be taking. Likewise, the penal provision that have been imposed, although SOP circular was there even earlier also, but there were many cases wherein the person used to make a request but still the company, for whatever reasons, was not filing with the application. So this penal provision on the company would again act as a yardstick that if an application has been received, the same has to be filed with the exchanges on a timely basis. Now, with regard to one of the points, that non-traceable promoters, I feel this is a genuine problem with many of the companies wherein a person has been named as a promoter or a promoter group, although he doesn't belong to the promoter group, but still his name is appearing for times immemorial in the shareholding pattern. So maybe SEBI can come out with a little relaxed way or a solution to be able to find a way how these persons, such persons, can be reclassified from the promoters category. These are my points with regard
Okay,
to
but don't you think that since they were reworking on this provision, at many a times we face challenges in many applications, like where there is an estranged relationship, or there is, for any very reason, it can be very sad that these two persons are not related in any way, but you'll still find, I've seen that we find challenges in getting the application through. So I believe there must be some other
So, Ankit, we don't
other
have to
provisions
look,
where there can
I'll
be
tell
some
you,
more
yeah.
suggestions can
We
be
don't
made.
have to look into direct relationships only while approving, while considering a reclassification application. Exchanges do not look into merely the direct relationship that, okay, we are brothers, sisters, we are siblings, but still they also look into the holding of, for example, I want to be reclassified from my brother's company. They will see where, at what all places, what all companies in the promoter group I am holding indirect shareholding. Even that matters. So those things we have to do a detailed analysis before we file a reclassification application. And that is where these provisions will come handy.
Okay.
Anjali, why they are saying NOC before filing? So
That's what I'm trying to say, that because otherwise earlier we used to go to the exchange at the last stage, wherein everything has been done and shareholders' approval has been obtained, and then we used to go to the exchange for their approval. And
so
then
whatever queries stock exchange is
they
raising
would be
first,
resolved at the initial stage itself. And we have Lokesh with us. Probably he'll be able to throw better light on the exchange's perspective to this.
Yes.
Lokesh,
So,
can you just tell?
yeah, can you hear me?
Yeah.
Yes, we can hear
Yeah,
you.
we can.
Yeah, the couple of things what we've seen that company take a board approval and board NOC, and then they go to shareholder for the approval. And after that, we realize that the company,
Lokesh, your voice is cracking.
yeah, what shareholder at first place, because regulations say direct and indirect. So promoter is outgoing promoter, and his relative should not hold more than 10%.
Lokesh, some signal issue. We are not able to hear you.
Now you can hear me?
Yeah, better.
So the regulations say directly and hold more than 10%.
I think we can come back to him after the presentation.
Lokesh, I think
once in a better
just correct
connectivity
your,
area.
there's some issue, it's not clearly visible. Ankit, you carry on. I'll ask Lokesh about this
Okay,
issue.
so then another important suggestion is that there are a lot of requirements on the KMP directors and promoters. Companies have to undertake certain compliances basis the information that they receive from promoters, directors, and KMPs. There was no standard set of regulation that cast an obligation on such promoters and directors to share those information with the listed entities. So there is a provision that is proposed to be introduced where an obligation will be created on the promoter group, KMP directors, to ensure that all information that they are supposed to provide to the listed entities to ensure compliance with the LODR and other applicable laws shall be provided from time to time basis. So there will be a regulatory obligation that will be there on them. Related party disclosures. So similar to certain exemptions that have been given to listed entities, there is a recommendation that similarly, if there is a certain corporate actions by the subsidiaries which is uniform for all the shareholders, then they will be exempted from the related party transaction requirements under the LODR. Currently, there is a exemption of FDs with the banks and scheduled bank, This is proposed to be extended to also for opening current and saving accounts. Then there is also a recommendation that proposal was considered that when something is purchased from any listed entity, subsidiary by directors, employees as a general customer without any business relationship on basis which is uniformly applicable to all other customers, all those things will also be now will not be treated as part of the related party transactions once this finds place in the LODR regulation. So this is also a much needed clarification that was required. So if it can be introduced as part of the exemptions to the definition, then it will bring much needed relief. I don't think there was a requirement of on terms uniformly applicable to all employees and directors, because if something is purchased outside as a normal customer, then we should be treated as par with all others. Similarly, there is an also requirement of exempting the requirement of seeking approval of remuneration and sitting fees paid to directors, KMP, senior management not related to the promoter group from the requirement of audit committee approval unless and until it's a material transaction under regulation 23. So currently there is a requirement of seeking approval from NRC, then you have to seek approval from audit committee because it's a related party transaction, then you have to go to the board. So in some cases where they are not part of the promoter group, the requirement, the approval requirement will not be there unless and until it's in the material. Generally, remuneration setting fees tends to not to meet the eligibility criteria of being a material party transaction, considering that it's being in a very higher limit. But yes, there is a provision. If it is a material transaction, it will go to the audit committee for approval. Then there is also a proposal to allow rectification of omnibus transactions, because many of our clients also and committee also received a lot of suggestions as to that there are cases when the limits are breached. So and there is no provision for rectification, while under the Companies Act there is a provision for rectification. Under LODR there is no such provision. So a proposal has been made to allow rectification within 3 months or the next audit committee meeting, provided that the transaction value does not exceed 1 crore rupee. It is not a material transaction. You have to explain the rationale, and there is all in the Half-yearly report, a disclosure will be made as to the transactions which have been ratified, and audit committee may also set some other conditions as it deems fit for ratifying any such transaction. Similarly, provision of omnibus approval shall be made applicable to RPTs by subsidiaries. I believe currently there is a requirement of seeking the approval of the holding company when the related party transaction exceeds 10%. From the reading of this proviso, it appears that all transactions said to be covered. I believe that should not be the intent. That only the transactions which are required to be approved by audit committee, if they are exceeding the 10% standalone turnover requirement, and if they have to be approved in an omnibus mode, then they can be approved by the audit committee on an omnibus approval. Then there are certain other exemptions and changes that are proposed, like payment of statutory fees to central and state government by public sector companies. There is also a proposal to amend the exemption from current two government companies from two public sector companies, because public sector definition as given in SCRA is much wider. It also tends to cover public sector undertakings which are not companies, which are body corporates. So therefore, to enhance that exemption, it is proposed to substitute the word government company with two public sector companies. Similarly, a transaction between a public sector company and the central government or a combination will also be exempted. So these new additions will be made in the exemptions. Payment of statutory fees to central government, transactions between two public sector undertakings, or transaction between one public sector company and a central or state government. Similarly, there was also a suggestion that was considered that fees, which is remuneration and sitting fees, which is paid to the directors, KMP, or senior management if they are related party, which are required to be disclosed as part of the half-yearly disclosure regime under RPT. There was a suggestion that this can be avoided, considering there are other disclosures that are being made as part of the annual report. under the Companies Act, under the SEBI LODR regulations. So except where they are not related to promoter group, the disclosures with respect to remuneration, sitting fees paid to directors, KMP, senior management will be exempted from the half-yearly disclosure requirements under Regulation 23. The disclosure will only be required in case they are material. Disclosure of material timelines, that the committee considered the suggestions of relooking into the current requirement of disclosing certain events within 30 minutes if this event has been considered by the board. And the committee, I think, deliberated on that subject and came out with different set of proposals to as to the manner as to how it will be dealt. So, for example, if a meeting ends after the trading hours on a day, but before 3 hours, the next trading session, then the disclosure can be made within 3 hours instead of 30 minutes. So if the meeting ends after trading hours, but much before 3 hours from the start of the next trading session, then it has to be disclosed within 3 hours. If the meeting ends during trading hours or within 3 hours before the next session, start of next session, then it has to be disclosed within 30 minutes. The committee also gives you a tabular example as to how one can understand that how this disclosures will be made. Similarly, for disclosures related to litigations on claims, where one needs to understand the quantum of claim in terms of the materiality, it is proposed that the current requirement of submitting the same within 24 hours may be extended to 74 hours. So there are two. One is with respect to the board decisions, and another is with respect to litigation and other claims where you have to ascertain the claim in terms of materiality, and then you will disclose instead of 24 hours, you can disclose that within 72 hours. Then there was also some suggestions on relooking into the current requirement of disclosing where a listed entity acquires 5% shares in any company directly and indirectly. So there is a proposal to increase the limit from 5% to 20% and the change limit of 2% to 5%. So if you will acquire 20% or more, then only there will be a requirement of disclosing. But for all disclosures of 5% or changes 2%, it is proposed that these disclosures will be made as part of the integrated filing, that is the governance reporting on a quarterly basis. So the requirement of immediate disclosure will restrict itself to 20% and then subsequent change to 5%. Then quarterly disclosure with respect to all acquisitions where it is 5% or more or change is 2% or more on a quarterly basis as part of the CG report. Then separate details are proposed to be incorporated as to what needs to be disclosed when there is a disclosure with respect to a new company to be incorporated, like in which sector it is proposed, what quantum is proposed to be invested, which sector. All these details they have outlined a list of items that you need to disclose in case the disclosure is required to be with respect to company to be incorporated, because as per the last amendment, the disclosure under the details with respect to acquisition now also covers the shares you acquire as part of a new company registration. Then with respect to disclosures of tax litigation disputes, including tax penalties, there are proposals that tax penalties and other proposals related to tax disputes and litigation will not be considered as part of regulation para 20 disclosure in para A. It should be dealt as part of para B, clause 8, and has to be dealt in accordance with that section. Then the litigation and disputes which exceeds materiality threshold, it has to be disclosed within 24 hours. Quarterly disclosure on ongoing tax litigation and disputes exceeding the materiality threshold should be included in integrated filing. And tax litigations and outcomes which are correlated, there is a requirement of currently aggregating the quantum involved to determine the materiality. So all tax disputes and litigations which are where the outcome is correlated will have to be aggregated in order to determine the materiality. So there are specific suggestions with respect to handling of events related to tax litigation and disputes, including tax penalties. And they have also tried to clarify that tax penalties will have to be disclosed under para B, not para A. Then with respect to para A, clause 20, the compulsory requirement of disclosing all penalties, all such cases, penalties levied by the regulator's judicial body. There is a proposal that penalties have to be divided into two parts: one levied by the sectoral regulator and one by others. If it is levied by a sectoral regulator, then the threshold limit is 10,000 rupees to be disclosed within 24 hours. If it is levied by any other regulator, then the threshold is of rupees 10 lakh and has to be disclosed within 24 hours. All penalties below these monetary threshold has to be disclosed as part of the quarterly integrated filing governance. So the quarterly integrated filing governance will become a very substantiated document and will cover a whole lot of other disclosures that are not covered there. So 10,000 for sectoral regulation, 10 lakhs for all other regulators, quantum of penalties or fine, and then all fines and penalties below these monetary threshold have to be disclosed otherwise through a quarterly filing regime. Then there is a proposal that fundraising disclosures under this requirement within 30 minutes of fundraising disclosures have to be aligned with the requirement of prior intimation. As you are aware, recently the prior intimation with respect to fundraising has been only limited to issuance of securities. So similarly, post disclosure within 3 hours or 30 minutes will only also be related to where it is talking about fundraising to funds raised through issuance of securities. Disclosures by senior management is proposed to be only disclosed. Disclosure of fraud by senior management when it is related to listed entities. For directors and promoters, even if it is not related to listed entity, it will continue to be disclosed. And on forensic audit disclosure, there was a requirement, there was a suggestion that it only requires to be informed when it is regulated by a sectoral regulator or any regulator and it is related to some fraud or other things, on which the committee mentioned that there is already an FAQs on forensic audit disclosures, and those are sufficient enough to cover the disclosure requirement under these regulations. Other compliance requirements. So there is a suggestion of considering some relaxations for companies coming out of IBC framework. So 3 months to fill vacancy in KMPs, provided there is one KMP, 3 months to have board or committee, 45 days to 60 days for additional timeline in the quarter in which the resolution plan is approved. So these 3 additional relaxations are proposed for the companies having IBC framework, coming out of IBC framework. Then with respect to requirement of material subsidiaries, where you have to obtain the approval of shareholders for disposing material assets, it is proposed that if those material assets are proposed to be transferred to another wholly owned subsidiary, then the requirement of seeking approval of shareholders shall not be applicable. Okay, then there are certain proposals on the record date. It is proposed to reduce
Ankit, certain suggestions which are normal, just take less time because.
Okay. So I think we can avoid record date. Another important is that currently there is any restructuring if you undertake, then you have to obtain the approval of the exchanges. So
Ankit, Manoj can explain to this part.
Yes, Manoj, if you can.
Manoj, just explain this and how it will impact better to restructure the company and loss-making company can set off their
right.
Positive.
I think it is important amendment and it will relax the thing. So it says that generally whatever kind of a scheme there relating to the company needs prior approval of the stock exchange and SEBI, which takes a lot of time. Like it is talking about this cases where the company has accumulated losses, and because of that there is a mismatch between the actual net per share price of the company and the market price. There may be a disparity, or there may be unnecessarily accumulated loss in one side and security premium account or reserve paid up capital on other side. So many of the scheme comes where there is a requirement, there is a proposal to set off these so that the real value of the company's share is reflected in the balance sheet. So in such cases, the obtaining of approval of a stock exchange and SEBI was unnecessary, because it is already reflected in the balance sheet. Only it is the adjustment being done through a scheme, through approval under process under the Companies Act. So now they are doing away with the requirement of prior approval from a stock exchange in such cases. So it will fast track the restructuring of the company's share capital where there is already accumulated losses, and it will obviously help a lot of reduce a lot of hassle, because whenever we are filing the scheme, we need a lot of other documentations like pre-post shareholding structure, which will not get changed in such cases, or to obtain valuation report or a certificate from registered valuer saying that there is no impact of this scheme on the value of the shares of the company. So those unnecessary disclosures and compliances are done away with, and that is a very welcome approach.
Manoj, by doing this, the company which has a reserve and negative capital is there. So
Yeah.
they utilize it, use it easily, and make it companies positive.
Yes, if the obviously if the net worth is already eroded to certain extent, paid up capital is already eroded, they can easily set off those. Obviously, the approval of NCLT would be required as per the Companies Act, but other approvals would get this prior approval from stock exchange would be avoided. So around 4 months time would be saved.
Okay. ठीक है.
Okay, so continue with the other thing. So there is also some changes which are proposed with respect to disclosures of analyst and investor meet. Okay, so disclosure on media schedule is optional for listed entities. So presentations for analyst and investor meet, which is required to be disclosed upfront as and when you intimate the schedule. So therefore, that requirement is being modified, that you have to share the presentation just before the event on the day. Then the requirement of uploading the audio of the meet within 24 hours or start of next trading day continues to be there. For video recording, time has been given up to 48 hours. Then for keeping the audio and video recording, currently there is a requirement of, I believe, 5 years. Then it has been for transcript, it has to be maintained permanently. It is proposed. Then audio video recordings can be kept for 2 years, and transcript for 5 years. And then as per the preservation policy of the company. With respect to the current requirement of sending an abridged annual report to the shareholders whose email ID is not available, there is a proposal that instead of that abridged annual report, a letter can be sent with the link where that annual report can be downloaded. So the bulky or sorry, not very bulky, the average form, which is still much more than a single paper, will be no more. You need to send that, and you can only send a letter with a link with the description of the link where you can download the annual report to the shareholders who doesn't have their email IDs. Similarly, the requirement of there is a specific mention under the regulation 36(2) that it has to be dispatched within before 21 days. So the committee thought that the provision is already aligned under the Companies Act, and there is also a requirement of sending the annual report to the exchanges with the as and when the dispatch is started. So there was no requirement of continuing with this requirement. So that can also be avoided. Then postal ballot, some suggestions were on postal ballot, dividends and shareholder meeting to MCA. So to exempt the requirement of physical postal ballot unless and until requested by the shareholders, reduce the time of 30 days to 7 days as form of an e-voting. That is one proposal. Then requirement of sending dividend warrants will only be there when the amount exceeded 10% cumulative over the years. In that case, one can send a dividend warrant. Otherwise, all the payments have to be first tried to electronic mode only. Then to also permit virtual or hybrid meetings or a permanent basis, and avoiding the requirement of proxy forms, because you don't need a proxy for a virtual general meeting. So that is also one of the proposals. Then corporate governance, currently there is a requirement of top 1,000 companies to have woman ID and risk management committee. It is proposed to extend it to top 2,000. Similarly, top 2,000 to have more than one mandatory annual meeting of IDs which is currently only restricted to one. It is proposed to have more than one mandatory annual meeting of IDs without the presence of non-IDs. Compliance officer to be designated as KMP. In some cases where the company secretary of the company is not a compliance officer, some other company secretary is the compliance officer, then he is not a KMP. So there is a proposal to designate him as a KMP in case it's such a case. And then it has to be, and he has to be an whole-time employee, and he has to be one below the board, not one below the CEO or the MD. It has to be one level below the board of the directors. Then proposals with respect to secretarial auditors, there are proposals that the secretarial auditors appointment, removal, and other processes shall be aligned with the provisions related to statutory auditors. There should be some maximum time for which they can be appointed on individual and firm basis. There will be a cooling period. There will be a disqualification criteria. So there are a lot of provisions which aims to bring the regulatory aspect of their appointment, reappointment, removal in line with what is applicable for a statutory auditor. A much welcome proposal. Then similarly, currently there is a provision if there is an agreement between the shareholders, some investors or third party on profit sharing. It needs to be approved by the shareholders. There is a proposal by the committee that if there is some agreements which are subsisting prior to the listing and it relates to event post listing, then it also needs to be ratified in the first general meeting held after the listing. Similarly, AOA, MOA, profile of directors, employee related benefit team, they are proposed to be disclosed on the website of the company in the interest of the investors. And now I'll ask Nili to take forward.
Thank you, Ankit. Thank you,
on
Ankit.
ICDR.
Ankit, thank you very much.
Thank you, sir.
What I'll see, some questions are there and some questions are you also having. So just keep it ready. We will work out that what are the implication on this. So for certain issues which you think this is not clear, just identify. So Anjali, over to you for ICDR.
Thank you so much. Thank you, Ankit. First of all, my compliments to the entire committee who was working on these harmonization procedures, on these pointers with regard to bringing in the changes in the LODR or ICDR or aligning the provisions. So starting with the ICDR provisions which are proposed to be amended, majority of the provisions which are proposed to be amended are with regard to the IPOs, rights issues, or the QIPs. Few of the things which were already there but were not coming out very clearly, plus certain things which were not there, they are proposed to be added. Shivam, next. It's not moving.
Shivam, just
this Shivam. So, very important amendment that is proposed to be brought in is the price band advertisement. Although they are both the practices prevalent in the market, wherein sometimes merchant bankers are giving two advertisements, one for pre-issue advertisement and the other for price band. These are both given on the same day, but otherwise, the only difference is in the price band, the price finalization is needed to be given. So, like we prefer to give a common advertisement whenever the price is finalized. So now SEBI has mandated that there is needed to be, SEBI proposes to bring in only one common advertisement for both the activities. Then QR code is a wonderful proposition which has been proposed by the regulator. There are certain information which is proposed to be made public through the QR code, and this is something which is very convenient in the present tech scenario. And simultaneously in the prospectus, the pre-issue shareholding and post-shareholding of the promoter group and additional top shareholders is needed to be given. Pre-shareholding used to be there generally, but post-shareholding was not there. Now it is proposed that even the post-shareholding of these three category of people should be there. These amendments are proposed to be brought in for the IPO, FPO, rights issues and the QIPs. Now, voluntary disclosure of the proforma financials in case of public issues, rights issues, and QIPs. Presently, these requirements, the requirement of giving proforma financials is there in public issues and fast-track rights issues. But QIBs, there was no such provision. So it is proposed that these should be made as on a voluntary basis by the companies for the periods for the financial periods which have been covered in the letter of offer and also in the for the stub period. These have to be given even for the subsidiaries or businesses acquired or which have been divested during the financial period which has been given in the offer document. So the purpose of giving these proforma financials is to enable a better understanding, a better clarification as to the impact on the financials. For instance, in fact, the discussion paper, consultation paper gives it by way of an example as well, by way of graphs, that if we compare the normal profitability versus the proforma profitability, there would be a huge jump. It would look like a huge jump. But when we compare proforma to proforma, then the numbers would be easily understandable. Now, the requirement of making a public announcement and the draft offer document to be made public. Under the present norms, the public issues and the rights issues which require SEBI approval have to be made public for public comments for a period of 21 days. The requirement is that under the extant law, the requirement is that a newspaper publication is to be done 2 days before the a newspaper publication is to be done 2 days after the filing. So this 2 days is proposed to be changed to 2 working days, and the 21 days under the present law is from the date of filing of the DRHP. Now it is from the date of giving the advertisement. The 21 days public comments period would start from the date of the advertisement. This again is a very welcome proposition because many a times there used to be a gap as well. So this would be taken care of. ICDR allows us various objects. One of the objects that can be there in any offer document can be the object to make the loan repayment. Under the loan repayment, we require the companies and the merchant bankers require the same to be certified by the statutory auditor. These loan repayments can be either for the company or for any subsidiary of its. So there happens a situation where during the 3-year period, there has been a change in the stat auditor or the auditor of the stat auditor of the subsidiary, somebody else as compared to the stat auditor of the listed entity. So there used to arise a confusion as to who would be signing, who would be giving this kind of a certificate. So SEBI has now mandated that instead of stat auditor, it can be any chartered accountant having peer-reviewed experience, peer-reviewed certificate, who can issue this certificate. So this would streamline and this would make things easier for the companies proposing to come out with IPOs, wherein the objects of the issue is loan repayment, either for its own loans or loans to be repaid for the company subsidiaries. Eligibility condition under the present norms, a company is ineligible for an IPO if it has any convertible securities in its shareholding pattern, except for the ESOPs which have been granted by it. We know that under the SBEB regulations, ESOPs are even stock appreciation rights are a well accepted mode of remunerating the employees. So it has been decided, it is proposed that even the stock appreciation rights, any company having stock appreciation rights can also be eligible for for filing the IPO with the regulators, but there is a condition attached to it that the stock appreciation rights should be converted before the filing of the red herring prospectus. Under the extant law for a OFS, the maximum limit allowed is 20%, but there was a confusion that 20%, would this 20% include any of the transactions which have been undertaken before the filing of the DRHP? So now it is proposed to be clarified that even the transactions which have been undertaken before the filing of the DRHP would also be tantamounting, would also be computed within this 20% limit. Reservation for employees in the rights issue. There is a provision in the rights issue chapter that there can be a reservation for the employees of the company. But since rights issues are meant for the shareholders of the company, for the existing shareholders of the company, so it is proposed to remove this provision altogether. It is again a very welcome step, not required at all in case of a rights issue. Disclosure of pre-IPO transactions. Many a times it happens that the companies come out with IPOs or rights issues, but there are certain transactions which have been undertaken which are proposed even prior to the IPO. For example, there is a planning that after the IPO or after the rights issue, the company will enter into a scheme of arrangement. So those details are needed to be mentioned in the IPO documents or in the DLOF, so that the shareholders take a well-informed decision. So present lock-in requirements are there. 3 years and 18 months are the lock-in requirements, but to avoid this situation, and in case of CAPEX, whenever any funding is there for the purpose of CAPEX, the lock-in requirement is 3 years. But SEBI observed that sometimes to avoid this extended lock-in, the companies were taking the garb of a taking this garb under they were doing the expenditure, they were doing the CAPEX, loan was used for the purpose of CAPEX. So in that scenario as well, the lock-in would be 3 years and not 18 months or 6 months. There are certain provisions with regard to the harmonization of ICDR and LODR regulations. Under while preparing the offer documents, all the companies and merchant bankers, they prepare a material litigation policy, which under the LODR regulations has been already explained in length under regulation 30. But while doing the offer documents, sometimes there used to arise questions that this policy should be different from the one as mentioned in the LODR regulation. So now it has been decided that both the policies, whatever material litigation disclosure policy is there under the LODR, the same is needed to be followed under the ICDR as well for the purpose of preparing the offer documents. Likewise, for the purpose of aligning the terminology for identifying the material subsidiary by using the turnover instead of the term income under both ICDR as well as LODR. Ensuring parity in disclosing the material agreements by the shareholders, promoters, and directors for the listed entities or proposed to be listed entities. Compliance officer under the LODR, it is clearly mentioned that only a company secretary can be the compliance officer. But under the ICDR, this provision was not there. This clarity was not there. So now it is proposed that only a company secretary can be the compliance officer for both the regulations. Then aligning the definition of associate, financial year, securities laws, and SR equity shares as given in LODR, same to be followed for ICDR as well. These are the provisions with regard to ICDR regulations. Thank you.
Okay, thank you, Anjali. Thank you very much. Now I will request Lokesh. Lokesh, there are so many changes proposed by the committee. In your opinion, the things which are connected to the stock exchange and where, like first example of disclosure, system-driven disclosure, how you see all these changes, specifically where you people have to do certain things. What is your view? Then,
Yeah. You can hear me?
Yeah, now is better.
Yeah. So system-driven disclosure, it's already there for SST and PIT. And since all the data for shareholding pattern is already linked with the repository or exchange or with the MIs, company already uploading the promoter detail. The thing is that once the data is already there, why we need an interface where company submitted? So we had a detailed discussion on delivery. Since all the data is linked with the MI, why we have done system-driven disclosure through shareholding pattern or credit rating? Okay, the frequency can be increased. Currently, the shareholding pattern submission is a quarterly basis. Once the system is smooth, it can be done on monthly basis, it can be done on weekly basis, since all the data is again flowing to exchange through system-driven SST and KT. Similarly, for credit rating do have access of exchange system. They can upload all the detail on the exchange portal, automatically that can go to display. So that's actually ease of company, while company uploading every time the credit ratings they take, they review and they upload on exchange portal. This will entire eliminate, and the thing is that everything will go smoothly. Third is a more important API discussion, which everyone be talking. We are listed on two exchange. Why we need to file on two exchange? Why not we have a one portal? So that's had discussion long in the sense this requirement came long back 2006 also we would be discussing. Now the thing is in API, what we are doing is we are not changing the interface. In the sense, whatever you are filing on NSE or BSE, one of the exchange, wherever you are filing, we will be giving an option to company. Company will be filing on one of the exchange. Automatically, both the exchange will talk to each other and they will upload the file. So it will be a smooth process. Rather than filing on one exchange, it will be filed on, rather than file on two exchange, it will be filed on one exchange. File will flow directly to other exchange and other exchange will disseminate the thing. When this will be implemented, we are targeting that 1st October, the first filing of 1st October. So what we are doing that we are doing in a phase manner. First, we will focus on experience. Again, someone has an investor grievance report and maybe financial result XBL submission that we are planning to do in phase 1, that is somewhere in October. 1st September filing, we are planning to release this. So that company has to upload only on one exchange, or the file will go and it will disseminate. Company will get acknowledgement. Company will everything will be disseminated on a website, and simultaneously you can see on the exchange portal that that same file has been done. And
Okay.
over time, every quarter we are removing it. So ultimately, going forward down the line, 6 months or 9 months, entire submission will happen on one of the exchange. So that's the whole idea.
Okay. So, Lokesh, other than this, and what like reclassification of promoter, that was when you were disconnected. So, can you just tell by proposing these things, where first you have to take a NOC from the stock exchange and then you have to go for reclassification, what will be the impact of this?
So the idea was that we have seen couple of cases where exchange once company take shareholder approval, they apply to exchange, and we have seen many cases that there were non-compliance. The indirect, the promoter, outgoing promoter or promoter group were holding more than 10%, and it's not the right thing that going to shareholder again. So that's why the whole idea of decision in the committee was that cannot we do it at P stage so that exchange grant approval and then it's operational process shareholder approval is taken. So that's the whole idea. It's not that 100% you take a shareholder approval, you would be eligible for a reclassification, because exchange also check you have indirect control. So that's why exchange also monitor all these things. So many instances we have seen and we have rejected the application. In the sense, rejected in the sense, written the applications. Company has withdrawn the applications. They were not meeting the regulation criteria.
Okay. And tell me, now related party transaction, they have structured something, simplify things. So how will stock exchange will monitor this? Because now there are so many things they have excluded. There are so many things they have fixed the threshold of materiality. So how you will judge that this materiality stock the company has correctly identified?
So that's the idea of XBRL. That's why we have started taking all the data in XBRL. Once the company entered all the detail in XBRL, everything is there, PAN number is there, our system can throw an alert. Because PAN is a unique number. We have a turnover, whatever the turnover of the company is there, 10% threshold is there. We can generate a system whether the shareholder approval has taken on particular PAN or not. Because again, the notice to shareholder is there in XBRL. So all this data is there that which will help exchange to monitor whether the company has taken a shareholder approval or taken or not. Whether they have taken audit approval or not, that data will not be having, because we don't know. Whatever they are submitting, we are assuming that they have taken audit approval. But shareholder, since this data is available with us, that we will be monitoring.
Okay. And the point of a scheme involving reduction of capital, where there's no need to take a approval of the stock exchange, do you think it will give a good amount of restructuring cases in India?
Yes,
Because-
yes. In fact, we are also not value adding in that process. It's just an operational thing that we were doing it. Because anyway, there are no share issues. It is only just a reduction of capital on all the shareholder. So ultimately, as exchange, we were not doing any additional thing and unnecessarily creating a lag, and this has been removed. This would be a faster way of reduction of capital.
Okay, okay. So any other point, Lokesh, which you think people should know, and what is a stock exchange will doing differently? Can you just explain?
Yeah, point so asking that already there in LODR, 3 months time was there. So for committee also, we have already passed. We have issued a circular and FAQ that we will give 3 months time. It's just that this consultation paper has talked about it. It will come in a regulation. Although exchange was giving a 3 months time for the committees, it is just that it has come in the consultation paper, and in the regulation it will be for independent director, any director who is resigned, or any vacancy is being created. 3 months is being given. For the committee also, similar type of 3 months will be given. So which was not in the regulation, but exchange was following that. Similarly, for an outcome of board meeting, this was a long debate question. 30 minutes were not possible. If you go any company, they will say that 30 minutes were not possible. So some companies, what they were doing, that the last person who signed, because sometimes they have multiple auditor, multiple director, whoever signatures are there. So multiple people signature. Last people who signed, from that time they calculate 30 minutes, which was ideally wrong, because once the board meeting over, that should be the 30 minutes. So that was a long discussion. It should be more time should be given. So the committee, after a lot of deliberation, it has discussed that during the market hour we cannot change because this practice is being followed. But after market hour, we would prefer more companies should give a result after market hour, and then the more time will be given to company and company secretary, so that they have sufficient time. And what we have seen, that while uploading the document, outcome of board meeting far away, multiple companies sometimes miss one of the document page. So because you have 15 to 20 pages while uploading a financial result, sometimes they miss cash flow, sometimes they miss audit report or one of the page, because the time limit is the crunch for the company. So this giving an additional time, company secretary will also have breathing space, and they can upload after market. There is not a much impact.
Okay, okay. Okay, thank you, Lokesh. Now I will take up Geetika, then we'll go to question answer. Then we'll discuss each and everything again. So, Geetika, now you are the member of this committee, and there must be some thought has gone into this. I think Geetika is docked. Shivam, just check Geetika. So, till the time Geetika comes, I will just suggest, Ankit, we have to see this part also, because they are saying LODR and SEDR, what is the link, what is the alignment? But there are so many things which are connected to Companies Act also.
So, sir, they have mentioned in the disclosure, I think one section where we talked about the suggestions that they will be making to MCA on certain changes, like with respect to postal ballot, AGM, permanent hybrid meeting. So they were proxies will be inherent, because if currently also in a VC meeting proxy is not allowed. So if it becomes a mandate, so it will automatically become
So what
irrelevant.
about the because ministry is extending, they have not make a permanent.
Sir, I think it is proposed as part of the next round of amendments in the Companies Act, because the Companies Law Committee in their last report have already suggested that to make this as a permanent fixture as part of the act.
Lokesh, you want to say something, please?
Additionally, one thing which I want to tell about the website disclosure. So main board companies, big companies, they have their IT team who upload whatever the company submit on exchange portal. That's a major ease of for small and mid-sized companies where they do not have an infrastructure on daily basis or on one of a frequency basis uploading on the website. Second thing, we have been receiving a lot of investor complaint that the format which they upload on the website is also cumbersome. In the sense, the shareholding pattern which is there on exchange website is more friendly compared to what is on company end. So that also is now company are not required to upload whatever they are filing exchange portal. A link, a one-time link will be there. Automatically, the investor can click on that link. It will take to investor to automatic on the company page on exchange website. So that's a major relief which will be at company end.
So this seems this thing which you are suggesting, like voting and attending meeting, both the things can be done by this, because today when we are receiving various notices of companies that this is the board meet, this is the general meeting, you'll join this link, this is other thing. So it is not better that I should go to the stock exchange site and just click that company, and wherever voting is there, I can vote it. So unnecessary emails which are coming and through that you are doing, it can be we can avoid.
Okay, that part was not discussed. It's only the part which company upload whatever they are submitting on exchange portal, whatever exchange it's submitted on exchange website, all the LODR submission that they need to, one of the regulation 46 said that need to be uploaded on the company website.
Okay.
Which is easy. This has not been discussed for investor point of view. Maybe we can discuss, but as of now, this has not been discussed.
Okay. So Geetika, because you were the member of this committee, and there is a detailed discussion and thought process has gone into this. And first of all, Ankit has already told, and Anjali has told this, that thanks to the committee that they have really worked for the ease of doing business. And there are so many things which are irrelevant has been reduced, and practicality has come out in the entire process. So just give a overview of this particular changes. Ankit and Anjali has explained in detail, but the thought process, why it has taken place, and do you think how will it impact, because you are also a company secretary of a big large conglomerate, so that's why you know what pain is there, that's why you were suggesting. So now please tell us the overview and the things how it will change.
Sure. Good afternoon, everyone, and thank you for having me here. Apologies, there was some issue with connecting. I was also present when Anjali was presenting on the changes, and maybe just an overview would be that when this committee was formed, the scope of the committee was to bring ease in doing business across the listing regulations, and also harmonize a lot of areas between ICDR and listing regulations, and all of those you would have seen. However, between announcing the committee and us actually starting the work, there was another press release of October 2023, which most of you must have seen, where comments were received from the entire industry on whatever their pain points were. Therefore, I believe SEBI did a good work of collecting the difficulties, and all those were brought to the committee. The committee was divided into two parts. One which worked extensively on the listing regulations, and the other which worked on harmonization of the other laws. We also had a good opportunity of looking at other laws like buyback, ESOP. All those laws were also brought into the scope. And when I speak of listing regulations more specifically, I think the framework that we had in mind was that a lot of us over the years have seen so many amendments, especially post Kotak. And we also, one of the complaints that the industry always has towards the regulators is in terms of the number of amendments. The thought here was to try and bucket all those areas which are either troubling us fundamentally, things like few areas in related party transaction which had become a very big crying point for us as industry. So those are very fundamental areas, rumor verification, which needed a lot of clarification, filing of litigations and non-compliances or orders. Those were fundamental areas where I believe we needed clarity. Then there were a lot of executional areas where, for example, if an organization is filing merely outcomes after the board meeting, we are filing them on multiple portals. If a company is both equity and debt listed, you are filing, and you have multiple ISINs and you need to file them on multiple portals. There, I think Lokesh is here and he'll speak. I'm sure he must have spoken, where the attempt was to try and consolidate these filings, both in number of the reports that an organization files, in terms of frequency and the kind of reports you file, and also at the end of the stock exchanges who've done a fabulous work where they are trying to create one lead stock exchange or one portal where it will get disseminated. So a lot of these executional administrative burden was also looked at. I must say that SEBI has done a very fabulous job of balancing out suggestions. While they've been very open-minded about the difficulties that the industry is facing, and has tried to bring out most of these, as you can see, those 51 suggestions which are in front of you. At the same time, we also saw a little resistance in terms of making fundamental amendments to the new laws. And when I say new laws, comparatively market rumors, rumor verification, and filing of case laws and all these areas, BRSR Code 3, these are much newer amendments. And there we did see some resistance, logically so, because they also wanted to see how the industry is able to either comply with this, and if not, they want to bring about amendments. And therefore, I believe that while we had about, if I'm not wrong, we had about 22 plus meetings across the group and the subcommittees. And I genuinely feel more as a compliance professional than as a part of the committee that this should bring about a lot of ease in terms of both day-to-day work, as well as if you look at the exemptions and clarifications around related party transactions, that should also bring about a lot of ease. And that, I think, is the perspective. And my request to the industry, to the audience, to the members of this webinar as well, is that this is open for public comments. Do please share your thoughts along with the rationale, so that it helps us in understanding the areas if we have missed out any while looking at this from a committee's point of view. I think that's about it.
Okay. Thank you very much. Thank you. Now, I'll just take up questions. So various questions are from my side first. Geetka and Lokesh. One is very nice suggestion. The single filing system is there. So you file in one stock exchange, automatically it will go to other stock exchange. That is part. And I pray that they will also be there, because in the entire world, registrar of company is the place where you are filing your document. So today they are doing inter stock exchange, but tomorrow they will come that you file your document in the ROC office, and it will go directly to the stock exchange and other places. Yeah. So one place is the system is there. So manipulation and the delay and other things can be avoided. Or you file in the stock exchange and this is going to ROC, so it can go from the stock exchange to the ROC also. So I think something can be worked out, because stock exchange is limited information and ROC is a limited information you are filing. Stock exchange, every day you have to file something. So that is number one. Number two, the integrated periodical filing is identified. That is also a good move, that in place of small things you are filing, they want to avoid this, and in place you just file integrated. So even if you have filed something integrated, you have to again file it. So I think this is a good move. But my suggestion is that they have given various information, you file it, like bonus, buyback, commercial paper, so many things they have recommended. So I just want to understand that today what is happening, go to the stock exchange site, you will find so many compliances paper are there. They are good for the stock exchange, they are good for compliance, but not good for the investor. So can't you do like this, that certain things are not relevant to the stock, not relevant to the investor? That what you have done, you have sent a notice to the company, something. So can can stock exchange make that this is a portion for investor? I will open the investor portion. Why? What I am interested? I am interested in 2-3 things. Where is the result? What is the corporate action which are there? But I'm not interested to show me all the disclosure as a normal investor. If a big investor is there or somebody is tracking the company, then they want to see who is buying, who is selling, but not as a general investor. So can they divide all these compliance related things and this in a further streamlined manner? Geetika and Lokesh.
Lokesh, do you want to take it first?
You can take it, no problem.
Yeah. I agree with this suggestion partially, but I actually will leave it to Lokesh because he needs to tell us what is practically possible or not. I have had my share of multiple debates with him at the committee. But Lokesh, your thoughts on this?
Yeah. So if you see a couple of suggestions that are there in committee, like loss of share certificate. If you see every day a company which is listed from before 1990 or maybe 2000, every day an announcement is come. So anyway, that has been gone away. So now anyway, number of filing has been reduced. The whole idea was, well, discussion with that, we should also look on a number of submissions which are more relevant rather than coming similar like acquisition 2% or whatever 5% acquisition or disclosure was there, which has increased to 50 whatever 20%. So by that, anyway, only critical information is going to come once this is implemented. Half of the things will go away. 7.3, which is RTA disclosure, 40.10, it automatically it's going away. And,
Lokesh, I have read this and I'm very happy that these things are going away, which has more in number, but less in content. Okay, I'm just asking that all these compliances you fill it, but something which are not relevant to the investor as a normal investor, because all this information is for the normal investor. Can we take out the relevant information and put it as the investor column? There's no need to file separately. Only thing is that categorization which are relevant 1, 2, 3, like corporate action is important for the investor, it will reflect. Dividend information, board meetings information relating to result, it is important. Board meeting related to corporate action is important. Rest of the normal board meeting is taking place where there's no other information that can be identified separately. So Geetika, your view.
We can work on it. Just now on exchange portal, it's already been a bifurcation of board meeting tab is separate, corporate tab is separate, financial result tab is separate, announcement tab is separate, corporate governance tab is separate. But we can work on that. Maybe we can think about that part also.
I think one of the other points that came from another forum that I attended today was a very relevant point, that one of the new amendments about 6 months back requires companies to upload notices and orders if there are any such of the penalty. And the industry is facing a lot of problem in submitting those orders per se itself. One of the reasons for submitting those orders, or the issue with difficulty with submitting those orders, is that it can have a lot of competitive information. It can have a lot of extra information which is not relevant to the investor. I pick up that point along with what Mr. Vijay is saying, that out of the entire gamut of disclosure that an organization files, maybe 80% of what gets reflected is relevant for the investors. The other 20% is rather for the consumption or analysis of the stock exchange. Can that be moved separately, or can that be plugged separately is a question, and I think we'll leave it with us. Once a point valid taken, Lokesh, we'll leave it, we'll keep it with us and see what's possible.
Okay. Now,
So my view is already exchanges have tried to bifurcate. For example, when we talk about shareholding patterns, PAN numbers are not needed to be disclosed to the public at large, not needed to be disseminated. Likewise, even when it comes to board meetings, those segregations are there, that what all board meetings advance intimations are required. Outcome, of course, we have to submit depending upon Regulation 30 coverage. So those things have already been tried to be done with, but still exchanges can look into a better way of representing.
Yeah. Okay, Geetika, another point is they are saying system-driven disclosure on the shareholding pattern.
Yeah.
So it will directly come from depository.
Yes.
I think this is a good move. Lokesh, what do you feel, that is there any problem in future for this?
No, there is no problem, because anyway system-driven data is coming. So the thing is that 6 month time you do quarter filing, company has to check whatever the data will come depository, either on exchange portal. We will issue a circular friendly with SEBI. A company has to check for 1 or 2 quarter, and then once the system is stabilized, it will be automatic flow. Because anyway, all the data is lying with the depository.
Okay.
So herein also, I think a cutoff date should be fixed by when every listed entity has to set their shareholding data correct. No reclassification. Anybody who's shown in the promoter, maybe he or she can be shifted to the promoter group category, or vice versa. Promoter to public will not be permissible. But so that once this data is uploaded on the depositories, or the moment we say ki SDD driven, it is the SDD driven, everything is streamlined and every company knows that this is the sacrosanct data and nothing permissible, nothing will be allowed to be changed here or there.
Okay. So the filling the vacancy of board meeting, that is a good move. I'll just see wherever it is timeline for shareholders approval for appointment, reappointment director. It's also good. Framework or reclassification, that have already spoken. Related party transaction. Geetika, now Ankit has explained related party transaction. Now this is one area which is always coming. I think the entire company law, the toughest portion has become the related party transaction.
Yeah.
And anytime, whatever you do, neither regulator will satisfy, neither you are satisfying, and things are moving on. So they are making law, you are violating, and their companies are searching a way out. So what is your call on the related party changes which has taken place?
I think the way I'd like to put it is that there were about, if I have to give statistics, there were about 1,000 plus suggestions only on related party transactions.
Yes.
And not just us, we had a lot of groups who were called, conglomerates and groups who were called to represent. And even from their suggestions, most of them were around related party transaction. This confirms the fact that you're saying that this still is a very troublesome area when it comes to compliance.
Yeah.
Not because people don't want to comply with it, but the industry still feels that there's a lot of burden in terms of the amount of disclosure that is required. We had also highlighted that no other jurisdiction in the world has similar disclosure regime that we have in India. Having said that, what we realized over multiple conversations there is that it's a sailed boat for us. The train has passed the station, and there is very less that we can do fundamentally. But the issues that we face, for example, exemption for ordinary course of business transactions, corporate transactions, regular retail dealings between either employees or KMPs or directors with that of the companies, those are the kind of exemptions that we tried to cull out. Also, there were a lot of issues that companies faced or clarifications required when a lot of half-yearly disclosures were being submitted in terms of remuneration paid to employees who are on the board of other subsidiaries and things like those. I believe those are the areas where we've tried to ease it out as much as we can in terms of execution. Fundamental shifts have not been achieved. Purpose and effect, we were convinced that there is per se no issue. And I also feel, not just because SEBI is saying, but per se, I've not seen companies not being able to do transactions because there's purpose and effect and things like those. So it's a balanced, what do I say? A balanced bucket when it comes to related parties transactions. We've been able to achieve much, and there is still some more area left. But as you rightly said, this is a sticky area, very sensitive from a regulator's point of view, and I very well understand when they are with their guards up when it comes to making amendments in this area.
Okay, Geetika, one question which has come. The omnibus approval of RPT by audit committee.
Yeah.
So the provision of omnibus approval under regulation 23(3) of LODR to be made applicable to RPTs by subsidiaries as well.
Yeah.
So this is Ankit. You have some question in this?
What I mentioned was that that there is a I think the requirement of taking omnibus approval will only arise in case the transaction value is beyond 10% of the standalone turnover of the subsidiary, and not in any other case.
Yeah.
Because it doesn't comes out like that from the report, so far as I read it.
Okay. Do please, Ankit, share your suggestions if it comes.
Definitely.
It's required in the draft language of the regulation also.
Sure.
Okay.
But sir, what was the question? I think it was the same question.
No, same. You were asked that
Okay.
time. You were asking omnibus present. So I was asking Geetika,
Okay.
what is the background on this? Okay. So Geetika, this time location, Geetika, the timeline for disclosure of material event information. Now, this you think because there is always a issue. Two aspects are always issue. One is the concept of materiality, and second is when to inform.
Yeah.
Now, materiality is coming out now, more clarity. Even still, it is confusion at so many places. But now, two aspects: materiality and timeline. What is the view and how you have? Anjali, you want to ask something on related party? Anjali?
So sorry, this is, I
Okay.
lowered it down. Yeah.
Okay. So Geetika and Lokesh, just can you tell the materiality and timeline? What are the now issue is there? Is it settled down or it is still multiple things are there?
Lokesh, you want to go first?
Yeah, sure. Initially there was issues, companies, there was delay, but over a period of time, what we've seen that now companies are in compliance, and in LODR also it's specified that in case you are submitting a delay, you just give a return. So we also have seen couple of cases where companies who wanted to they received on this time, but due to internal it got delayed. But that suffices in the sense we've been discussing with SEBI that's okay. At this stage, that's okay. But now things are more stable. In the sense, market is becoming more stable. Then now we are seeing less number of non-compliances compared to what it was there initially.
Okay, Geetika?
I approach this very differently. To my mind, there are two issues here. One issue is per se about, can I file within time? Do I know what I'm supposed to file? Am I filing it? Are the others filing it? Companies are continuously looking at each other as to who's filing what, how much who's filing. That's one part of it, the administrative part of it. But the fundamental part of it, which I have continuously raised again and again in multiple such submissions, is the relevancy of information. If the thresholds are not material, if the timeline is not comfortable, and because of the lower timeline, if I'm not able to make a proper disclosure, is this information that I am filing haphazardly or hurriedly with the stock exchanges, is it relevant for my investor? At the end of the day, I think all of us are working towards this entire gamut of activities so that an investor who's investing has symmetry of information with those of the insiders. Assume something is happening, a major case has happened, and an insider knows the details and the outsiders don't. You want them to know that ASAP. But please tell me, you receive a show cause notice or you receive a demand notice. Is it possible within 24 hours, A, to have received it, stamped it, known that the amount of penalty is how much, what is my status in that case law, am I going to fight against it or not? Imagine the kind of disclosure I'll make in 24 hours versus the kind of disclosure I'll make in 72 hours. The relevancy of that disclosure to the investor is important. We all have been here. We all have seen the kind of disclosures that have come in the industry. People have filed penalties of 112 rupees, and people have also filed multiple such, and people are doing extra disclosure. Now look at it. A company without taking names, a company of a certain size, when you look at their corporate page or when you look at the stock exchange website and you see 20 disclosures from them, please tell me, is an investor going to look at that notice and is that information relevant for them? So maybe time will prove, time will tell where stock exchange should actually, not stock exchange, the regulators along with stock exchanges help should actually do an analysis to see whether there has been a price movement, whether has that got stabilized, are the investors happy with this kind of a disclosure regime, and then everything makes sense. While that was on the fundamental point, on the administrative point, I don't think the industry has found an answer still. We still look at each other. We still try and confirm that our practice is best practice, and there is a lot more that will come out purely by precedences in this area. I don't think there is clarity.
Okay. Okay, now Manoj, there is one change is there in IBC framework they are suggesting. So they are saying that to allow company emerging from CIRP adequate time to comply. So 3 things they have mentioned: 3 months time for KMP, 3 months time for board committee, and additional 45 or 60 days annual result. So what do you think and how it will help?
Yeah, so many of the cases which are the company which have gone to IBC and then comes out has a lot of implementation issues remaining even after the order is implemented or shares are allotted as per the part of the scheme. The shareholding structure getting changed, reflecting in the market, may sometimes take time. Then because of the company's stature that it remain in financially stressed, finding good people to join the board as independent director or KMPs is quite difficult. So giving extra time is always relevant here, because obviously the situation was not as good as in the normal circumstances. So additional time is required, and it is a right move to give additional time for these kind of vacancy fulfillment by the new management, because new management is engaged in implementation of the scheme, allotment of share, making the investor satisfied about whatever they have done. Then a lot of filing being done in the NCLT and IBBI, informing about the implementation of the scheme, etc. Then bankers are also there, so certain portion may remain in limbo for certain times. So those things are going on. Hence, it is better to give extra time, and I think 3 months may be a short time for such kind of companies. Yeah.
Okay. So Manoj, because you are continuing, so I'm asking the scheme point of view, accumulated losses, because you have explained to this. Geetika, do you think this move has come? Any reason of this? When there is a loss, you can set off the loss from the reserve and make it positive.
Ankit, you're on mute.
So I think Sir is talking about the point where they have proposed to avoid the
reduction of capital
NOC in capital reduction, setting of losses.
Okay.
Yeah.
I feel it's a very normal difficulty that many companies were facing. In fact, a lot of such issues came to stock exchanges also. And it was a very logical move to have a set of them.
Yeah, so it is very much similar, like you are doing internal regrouping of the shareholding or paid up capital and free reserves, which happens every year in the balance sheet, and it has no impact on the financial health of the company. Hence, I think this move is very good and relevant. unnecessarily, because it is bracketed under the scheme of arrangement. Many additional requirements are coming out which are not relevant for such kind of schemes, like having pre-post shareholding structure. There is no change because obviously there will be proportionate reduction. Then there is a requirement to have auditor certification relating to accounting standard, which is also not relevant here. Then there is a requirement to have valuation report and fairness opinion. Obviously, it is not relevant here. So I think those requirements were not relevant, and hence the intervention of stock exchange and SEBI was also not required here. One regulator is already there, NCLT. We have to seek the approval of NCLT, and they will refer the matter to ROC and RD. So that is sufficient protection or checks and balances given.
Okay. Geetika, the analyst or institutional investor meet, that is a cumbersome process, that how many meetings you are taking, what you are saying, what are the issue. Now you are putting all these types of things. So location, Geetika, you just tell us that how this particular thing which they are proposing, and what are the problems the normally SEBI and stock exchanges are facing. That's why they have come out with this thing that you have to put on the video on the website of the website of the company, and then you have to keep record everything for minimum 2 years and preserve for 8 years. So what is the reason and why this is happening?
Lokesh.
So this was discussed why this regulation came. The first one is why this regulation came. SEBI, in a couple of investigation, it found that couple of information has been shared during the group discussion meeting. Certain set of information. So to stop that, that's the whole idea that it came. We discussed this matter in the committee also, in the sense this was discussed detailed and deliberate. But again, it was the whole idea that certain set of group where the information are shared, it's better that it should be disclosed, and whatever you're discussing in one-on-one basis or in the group meeting, it has to be in the public domain. That's the whole idea.
Okay. Annual report, I think this is a good suggestion, Ankit. I think it will be helpful for the company. Okay. Now, certain suggestion, Geetika, MCA on postal ballot, dividend and shareholder meet. When you are suggesting this thing, then you are aware that all these changes, till the time the MCA is not changing, you can put additional condition, but basic things you can't change.
Correct.
Now, 21 days notice, you are saying 7 days.
Correct.
So these things, unless you are changing company law, can you do this?
No. And this is, absolutely thought through and well aware of. The thought, even while discussing, was that not just through our discussions, but multiple representations that one received from the industry, that this is becoming a pain point. And it's high time that we have seen meetings happening through virtual mode over the last 2-3 years specifically. And therefore, it is much possible we can use this platform and SEBI's platform to be able to send these comments to the ministry. The thought is that if people are going to support this by giving and sending out comments to the consultation paper, then a note from SEBI can go to the ministry saying that the industry is also together with us in this. So it's more like facilitating changes in these areas. But we are very well aware that the stricter of the laws prevail, and this can only come in force if ministry changes the Companies Act.
Okay. So Lokesh, this now 1,000 company, they are increasing to 2,000 company for ID, meetings of ID and risk management committee. So the stock exchange is ready with all these infrastructure?
Yeah, there's nothing changed at the stock exchange, and it's not a mandatory increase. I think it's optional to the company.
Okay. Now, Geetika, this compliance officer position is strengthening the position of compliance officer. They are saying compliance officer to be designated as KMP and to be full-time employee, not one below the board of directors. Why this point has come? Because now company secretary is the compliance officer that is there. So do you find that companies as having a company secretary below the one rank that is there, not in the whole-time employment? Some practicing member is there or temporary person is there. So what is the reason to bring out these changes?
I think the reason is very simple. The role of a company secretary and a compliance officer at least 5 to 8 years before was very different to when Companies Act 2013 came, became much more wide and different when it came when the amendments in the listing regulations came. Now, a KMP, especially a company secretary, is equally duty bound to report material information, have SDD, ensure that things are uploaded within 24 hours of certain things happening, certain events happening. The real question is, while you have casted responsibility by virtue of regulations, have you given them the required authority to be able to receive this information? In most companies, one sees that company secretary is not necessarily reporting to the highest chair of the organization, which is the MD or the chairman, the place from where all such sensitive information either originates or is available at all times. And therefore, if they are reporting at least 3 or 4 level down, the access, their own access to that information is not available. You cannot make them liable to report information that they do not have access to. So if you're giving them accountability and responsibility under regulations, we might as well try and empower them through the regulations to be able to be in a position where they receive this UPSI to be able to deliver the required the deliverables under the listing regulations. It is coming from that place and nowhere else.
Okay. I have one question. I was just saying, and I have received the same question. Are we not bombarding the investor with many information, which are not only much relevant to him, but also cost incentive, as every compliance is a cost, which ultimately is a load on investor only. Better stock exchange and regulator, which collect so many information from companies, present before investor in the summarized form to enable them make informed decision. So same point which I was saying, collect all information, but display relevant information to the investor. But if investor wants to do something more, he can do PSD by going to the detail section. So this is one suggestion. Go, Lokesh, please
Sure.
keep in mind.
We will discuss internally.
Yeah. Another is, Manoj, in case of open offer, in the offer document, we have specified the intention of acquirer to become the promoter post completion of open offer requirement and declassification of existing promoters. Then at which stage reclassification application is required to make to the stock exchange, and what exchange see in the application when you are giving open offer?
So it is specifically mentioned. One of the clause under Regulation 31A is Regulations of Regulation 8, which talks about change in reclassification because of change in control pursuant to open offer. So if the open offer is given and the offer specifically provides for change in control, then reclassification is simpler. Simply intimating the stock exchange about the change would be taken note of, and reclassification happens. And that is a fast track process. So it will happen only after completion of the open offer formality, and then where the share is transferred and this is reported to the stock exchange. So
Okay.
at the end of the offer process.
Yeah.
Manoj, in this case also a reclassification application is still needed to be filed.
Yes.
Which
Application is needed,
approval
but it
is
is a
comparatively much simpler process.
Yes.
Yeah.
They will just look at the offer document and completion certificate of the offer. That's sufficient formality.
Geetika, Lokesh, this is also another suggestion is coming, and I am also echoing his point of view. He's saying regard ICDR compliance, we would be great to be on the part of the regulator to take very relevant point from bulky DRSP and put before the investor, as we see on 1-2 pager in the newspaper 2-3 days before IPO opens. The reason is that very few of the retail investors really have a look or have that expertise to analyze DRSP. Shall be great to have thought on the speakers on this, please.
So I think it's already been worked in the plan, which talk about main board IPO. Whoever launching video will be recorded for 10 minutes. Audio video will be there. So that's already member for investors.
Yeah.
So that has already been done. Rather than reading SEBI's advanced version, in the sense, now video will be coming for 10 minutes, which will tell about entire DRSP, which is more investor friendly compared to reading a DRSP.
Okay.
Yes, yes, the
Plus-
reading
plus-
habit reading habits are changing, and now people want to see podcast, video cast, and so small 10 minutes video would help to understand the factual position rather than going into the abridged prospectus and newspaper advertisement. Though newspaper advertisement are also now very bulky, two-pager, having all the relevant information, but still someone wants to read, they can go to the and download that RHP and or DRHP, RHP and the prospectus.
Geeta,
Also-
you have any?
Also, like we said, that it's important that we also adapt as time moves. How many of us actually open a newspaper and read an entire page? What we've
Yeah.
done is that also entails a lot of compliance costs. While larger organizations can easily take up these costs, and compliance cost should be something that an average organization could also be facing. And therefore, one said, let's have a extract of what is required in a newspaper along with a QR code. The QR code will still take you to the detailed disclosure of the website. And these days, most of us consume content on devices. So it's
Yes.
much easier to be able to do so. That was the whole logic of doing the
Yeah.
newspaper amendments.
No, but Geetika, my point is, Lokesh and everybody, I'm again saying it is absolutely right that you have all the information, you collect information, you give information. But my point is that I'm in this market, I'm a professional, and I'm the capital market person. For me also, sometime because of the time, because of the my interest on certain things, it is really difficult to get the desired result. Point is, everybody knows what investor wants. So that's why SEBI has come out that earlier you read entire prospectus or newspaper, two-page newspaper, you will not identify in which industry this company is. But now SEBI has made, and they are coming out with this, you have to write. Point is, these are the point has come out because of the investor need. Even today also, I am not interested in so many things, capital build-up, this, that is there. But one column exclusively for investor purpose should be there. The comparative uniformity should be there. I want to compare this company with other company. I want to compare the peer companies, listed companies, which has already come out. So certain parameters should be there which are relevant to the investors only. Small investor, normal investor, layman investor, because number is 10 crore today. And slowly, if you identified out of 10 crore, do you think these investors are knowing? No, they don't know. So that's why give all information, but one column, one pager, one side track you should give, which are only relevant to the layman investors. This is my view. Lokesh.
Sure, but the only thing is that if you see the disclosure point of view on DRHP, we don't know which investor will read which part. To talk about that financial, earlier standalone and console financial was required in DRHP, which has been gone away. Now only console financials are required. Similarly, outstanding litigation, companies were defining their own litigation. Now with the new consultation paper, now company at least will have a limited number of litigations compared to what they are giving in that offer document. Agree upon that summary page will be there. Maybe we can discuss maybe. But at this stage, the whole idea of that we don't know which investor will be reading what information and it will where it will be used.
No, I'm not saying Lokesh which investor. I'm saying you give all information. There are two students. One is that up to 12th class. One is doing PhD. So I'm just saying give information to 12th class person also, and PhD you are giving every information. Whatever he wants, you are providing. But out of this extract, you take out and give on a highlighted way that this is the information which every layman investor wants to understand.
We will discuss it. Maybe we can.
Yeah, Geetika, just take up this point and we will give suggestion also in the new things.
Yeah, that'll be helpful.
Okay, so friends, now it's time to close this session. We have Ankit has explained on LODR, then Anjali has given the ICDR. After that, Lokesh has given the stock exchange viewpoint. Manoj has given the two important aspects of IBC and the reduction of capital. Geetika has given the overview and why this has come, and a few questions we have received. So the point of thing is that today when we have discussed each and every item, certain issues is coming out. In place of, because Geetika was with me in the standard, we have identified when you are writing something, are you simplifying or you are creating some more questions? So the best part is that if you are changing language, you are bringing out some simplification. Under this process, it should not be some more complication. Or you are doing simplification, but more questions are coming. So it is better you plug these questions itself here. If you are saying you have to submit information within 24 hours or within 3 days or within, so everything should be clear that which information I have to give. So there's no ambiguity in this. So with these things, what we'll do, we will compile all these suggestions which we have discussed today, new point, and the questions which you have received and the discussion which has taken place, and then things we will submit. Before going to the everybody, I just want to request Shivam to show me the result of poll which he has taken. Shivam, can you just show? So which area do you believe requires the most urgent harmonization between LODR and ICDR? Disclosure requirement 48%, financial reporting 13%, corporate governance 19%, compliance and enforcement mechanism 21%. Next is, what do you think will be the biggest benefit of harmonizing ICDR and LODR? Increased transparency, simplify compliance 76%, that is absolutely right. Enhance investor confidence, better corporate governance, definitely simplified compliance will be there, so investor can understand better. Next, what future trend would you consider in harmonizing process of ICDR and LODR? Digital transformation 51, sustainability reporting 24, data privacy 17, and global trade practice 7. Next, so these are some poll which he has taken. So before closing this, I will request all the panelists just 30 seconds give their final comments. I'll start Lokesh with you.
So it's a good move. In fact, a lot of company pain point has come out in the sense one filing, then everything on multiple filings, multiple dates filing at a consolidated. A lot of ease has been done. So it's a good start for the company's point of view.
Okay, Manoj.
Yeah, so I see a lot of thought given, and industry's views have already been taken care of by SEBI. So it is very good consultative way of amending the laws. Harmonization is very much important, and it should be across all securities law. So that's a good move towards that direction. And I think post consultation from the public on this draft, there will be amendments. Some changes may be required, but still it is very good move.
Okay, Anjali.
The consultation paper reminds me of a common saying that we use in our office. गाड़ी चलानी है तो चारों टायर्स में एक बराबर हवा होनी चाहिए. It actually is the same thing. Unless we have all the laws in parity with each other, there would arise some issues or the other. It is a very good move of the regulator to in that direction. That's it.
Ankit.
Sir, I think Ankit is not there.
Okay, Geetika, your final comment.
Please send in your comments along with rationale within the timeline. We can all sit across and comment that regulators or people in the committee are either looking at stuff or not, but it's equally important and pertinent that we do our part of duty by sending in comments within the prescribed timeline. So please do that. That's the only request.
Okay, thank you, Geetika, thank you, Lokesh, thank you, Manoj, Anjali, Ankit, for giving this. And I told you in the beginning, the purpose of this type of webinar is that we should not be reactive, we have to be proactive. So that's why we have discussed, And now, after all these suggestions, which the committee did a wonderful job, we can add value even in 1, 2, 3, 4 suggestions. It will be good and it will come out with better law and better things. Harmonization is very important, and the harmonization between company law and the ICDR and LODR should also be taken care. So this is this. So thank you, friends. Thanks for participating. And this journey of knowledge sharing will continue. Our next webinar is 181 webinar on unfolding ESOP valuation and taxation aspect will be held on 19th July 2024. And after that, on 181 program will be on, we are organizing on KPI, because SEBI has asked the industry forum to give to come out with standard on KPI, the key indicator, performance indicator in ICDR when there is a companies coming out with public issue. So we will organize that program on KPI. That is another move which SEBI plan to do by simplify and standardize the process. Last point, thanks to all kind response with regard to audio-visual summarized version of DRHP. I second view of Mr. Vijay that the majority of retail investor numbering 10 crore plus regulator need to come out with the what he or she ought to be known to general investor come to know about the untowards event only when regulator detect and take action thereon. तब तक poor investor पैसा लगा चुका होता है. Okay. Thank you, Mr. Unialkar. So with these things, thank you all. Thank you and see you on 19th July at 4 o'clock with the new topic, unfolding ESOP, valuation and taxation aspects.